Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is Mickey Fulp, who is affectionately known as the mercenary geologist. He has an extensive background in the resource industry, as he worked as a geologist, and now he provides research and investing research for a lot of you resource investors out there and speculators, and he's a very successful investor himself. So thank you very much for joining us here today to weigh in on the commodity bull market, Mickey Fulp.
Well, thank you, Jason. I don't know how affectionately I'm called the mercenary geologist, but I certainly am the mercenary geologist, and I'm pretty much known for speaking my mind and calling a spade a spade.
That's true, Mickey, and you're a very honest guy. It's right in the title there, and you're from, Texas or the Oklahoma area, so you're a straight shooter, as you said.
Well, I'm originally from Missouri, and you have to show me, and I've spent well over two-thirds of my life as a resident of New Mexico.
Oh, okay. Okay. Well, before let's transition here right to the main topics. It's about the commodity bull market, and you have the people, the talking heads on CNBC saying commodity bull market's over. I don't think it's over. I think personally it's changed. What is your view on the commodity bull market in the last few years? Is it the same commodity bull market that it was the last 12 years, or have things changed drastically in the last 18 to 24 months?
I'm not sure things have changed drastically. I still am of the opinion we are in a secular bull market for commodities. And within any secular bull market, and these things usually last 20 to 30 years, you have raging bulls and you have bear dips, and then you have periods of time when commodities prices are flat. And that's, for the most part, what we've gone into over the last couple of years. Is we have not seen the raging price increases that occurred at various times in this secular bull market, which I think started actually in early 2003 for the most part. But that's to be expected. We still have the drivers in place, and that's growth in emerging market countries. With the internet and communications what they are, everybody in the world is able to see what we have in North America and Western Europe and parts of Eastern Asia, specifically Japan and Korea. Throw a few other places in there like Australia, and people, especially in Southeast Asia, China, India, Indonesia in particular, Brazil, what I call the BRICS. There are growing middle classes that want electricity, and they want small-scale electronics, and they want cars, and so those are drivers for an more industrialized world, and what I think is the commodities bull market.
Those are some interesting points, Mickey. Now let me talk about my views of the market and why I think the argument is why the bull market has changed. I agree with you that the developing countries are the drivers of the bull market, as the developed countries like the U.S., Europe, and Japan and those types are cutting back. They're learning to use resources more efficiently, et cetera, et cetera. They don't have as much demand for physical stuffs as the people who have growing purchasing power in the developing countries. But I've just seen, in my opinion, there's just been so many, base metal and industrial metal projects that have come online, like you have BHP Billiton and Rio Tinto and Vale and all those guys who have thrown so much money at copper projects, at high-grade iron ore projects, at coal projects. So those are the types of commodities where I think the bull market has changed, because China literally, they're not really using in my opinion, there's a lot of artificial demand in China for a lot of those things. They're not really consuming all the stuff immediately. Like some of the coal gets dumped in the harbor that China doesn't use immediately. There's a lot of coal in the harbor from accounts. There's warehouses and warehouses full of copper. Iron ore, they're building buildings that may or may not be filled for 2 years. So those are the types of things why I think the bull market has changed. Now, I agree with you for specific commodities like precious metals, food and energy, the softs. There's just 7 billion people on the planet, and that's not going to change anytime soon, in my opinion. That's probably going to grow. and then you have the energy consumption for the commodities. But what worries me in the commodities market is the base metals. I just don't see those as long-term investments anymore.
Well, I'm not sure if I will agree with that. Number one, there has not been lesser demand for basic industrial metals and commodities, energy, in Western Europe, the U.S., or Japan, Korea. In fact, we are consuming more of those. Look at the copper consumption this year. It was mainly driven last couple of years, in fact, by increases in North America and Europe. We are continuing to consume more. Our growth is not as fast. What you're talking about, I think, is especially with the industrial metals, copper and iron ore and aluminum are the three biggies, and well, you got to throw chrome in there too. They're the four biggies. Certainly, the short-term outlook on those could be less than they have been in the past. There is no doubt that there is stockpiling in China, but that's a short-term phenomena. And within the idea that we have a long-term secular bull market, as I said, there are bear dips within that market. So I'm not quite certain that your take is exactly the way I would look at it. Certainly the price of iron ore went down last year, but the price of copper held in quite nicely. It was range bound. It probably averaged somewhere between $350 and $360 a pound over the course of the year. And if you're a copper producer and you can't make money at $3.50 copper, then you need to get out of the copper business. The problem that we have is we are not able to find enough good deposits anymore. We've trod most of the places on the earth now. I'm speaking of geologists, and we've found most of the easy stuff. So there's been lots of projects that have been attempted to be put in production that they're bound to fail. At the same time that we have had very strong commodities prices, we had strong commodity prices across the board in 2012. But if you bring on something that is in the upper 10 to 20% of operating costs with huge capex, anytime there's a dip, that project's going to suffer, and those marginal projects continue to fail.
Yeah, that's what's been worrying me, is that almost all the copper projects, Mickey, that have been brought online in the last 5 or 6 years, a large percentage of them have just been so marginal. The grades are extremely low. I think it's like below 1% per ton of rock for the copper projects. And I saw a documentary a while ago. I forgot the name of the documentary, but the documentary said that we're mining lower grades of copper now than the grades of copper that is available in a landfill. So that's kind of disturbing to me.
Oh, that's ridiculous. I'm sorry, but that makes no sense at all. There's not a 0.5% copper available in any landfill that I know of. If it was so, we'd be out mining landfills. It's all about economics. Pardon me, but I'm not sure where you got that factoid, but I think I'll have to challenge that one, Jason.
Okay, I can respect that. I mean, I've seen so many documentaries that they don't present where their sources are in all of them, so. It is what it is, but what worries me, though, with the base metals is that I don't know if I see the commodity prices, like you said, that copper's been kind of range-bound, and that all the miners have just had rising input cost increases. So if the commodity price then is not keeping up with the rising cost input increase plus the real inflation rate, then obviously the profit margins are going to have to contract for the miners, and that's why I think the base metal guys are going to struggle more than, say, a uranium producer going forward or some of the other commodity supply-demand fundamentals I like better.
Well, your point's well taken there, but if high-cost producers suffer when prices dip because they have high operating costs and they have lots of debt to service and capital to pay back, then those go offline, and the cure for low prices is low prices and vice versa. This is all about supply-demand fundamentals. If marginal copper producers quit making money and they go offline, then what happens to the price of copper? It surges, and all of a sudden, here's everybody ramping up again. The problem we are probably facing is on these giant copper deposits, the lead time is quite long, and that's of concern. But all in all, I have to say that I still remain a very much a bull on a long-term secular bull market in commodities. I think we're only, at best, we're halfway through it at this point.
Okay, very good. Now, let's drill down to the actual companies and talk about some of the project economics. In the recent past, Wall Street for Main Street has interviewed Rick Rule, Nolan Watson, and Peter Grandich in the last few months, and these men have been investing and speculating in the resource industry for years, along with financing the juniors. Now, people like Rick Rule and Grandich will not buy juniors. Do you think they're wrong, and should retail investors be buying juniors, even well-researched ones, right now?
Well, I might challenge you. I haven't listened to Peter for a while, so I'm not sure what Peter's recent take is, but I certainly am familiar with what Rick Rule's doing, and to my knowledge, Rick Rule is putting money into private placements, and he, based on some of his interviews now, is saying this is absolutely the opportunity of a decade here to go in and pick off fundamentally strong juniors. I'm certainly familiar with a couple of private placements he's done within, say, the last quarter, where I have taken down some of that money too. So some of those shares too. So. In my opinion, yes, you've got to be very careful in this market. It's pretty certain to me that in a year or two that the majority, perhaps even 2/3 or 3/4 of the juniors that exist now will not be trading under the same name, under the same symbol, with the same share structure that they do now. So, in other words, the majority of juniors are likely to fail in the next couple of years, and I would count things like a rollback and a change of direction, a change of property as a failure. But there are still, in these raging bear markets like we have right now, we're approaching a 2-year bear market. It'd be 2 years. A high was established in early March of 2011, so we're 22 months in it. Certainly, there are companies, good companies, that are strong and will survive, and it's even more necessary for not even professional investors like Rick and Peter and myself to do our own due diligence, but it's incumbent upon the retail lay investor to do very strict due diligence, tighten his criteria, and make sure the companies he picks at the lows or even the bottom of the market like we're looking at right now, that those are the ones that are going to survive. This is, in my opinion, a great buying opportunity. Now, realize I'm a contrarian. I think Rick Rule would call himself a contrarian too. And so what I've done is I've been tax loss selling, and I'm buying a couple of issuers right now. Some of the things I've tax loss sold, I intend to go in after 31 days and buy those back.
Very, very good. Now, before we get into your checklist for specific companies and what to look for when you make investments into them, what commodities do you like best as far as supply-demand fundamentals over the next 2 or 3 years?
Well, certainly gold is always the top of the list, basically because fiat currencies are continuing to be devalued by strokes of keyboards, not so much by printing money anymore. So with the idea that gold retains its purchasing power, I would expect the gold price, at least in fiat terms, is going to increase. I remain a copper bull. I think copper is will continue to see 4% year-over-year growth. It's been doing that year-over-year with some perturbation since 1900, and this is driven mainly by 25% of the world still can't turn on a light and get electricity, get light at night, turn on a light switch. I am bullish on uranium for the mid to long term because the supply-demand fundamentals are very skewed toward the demand side. So uranium looks very good to me, and I have been picking off undervalued uranium companies over the course of the last year. Oil and gas, oil looks to me to be in a nice supply-demand balance, so I would expect the price of oil to remain high, and I consider high $90 a barrel. The gas sector has been totally beaten up. Basically, that is a North American phenomenon because we don't have an ability to arbitrage our gas for gas worldwide. The future of gas is LNG, liquefied natural gas. What we are lacking in the United States is infrastructure to get the gas where we need it, and things such as being able to pull off the interstate and fill your vehicle, especially long-haul trucks, with natural gas versus diesel. So in the mid to long term, I would be bullish on natural gas.
Yeah, with respect to natural gas, you have the Pickens plan, which, I mean, it's getting government help. I would prefer a free market solution and for the market to go in there and solve those problems. But I think the natural gas infrastructure stocks, like you talked about, are much better investments at this point than a lot of the natural gas producers, because most of those guys, their balance sheets are bloated with debt. They've had to write down their assets and their reserves massively, and there's still a little bit more pain because it just seems like every time the natural gas price goes up a little bit, right, more supply just keeps flooding back online.
Well, that's true, and we would expect that because there's lots of shedding gas from shale gas plays, especially in the mid-continent of the United States. And so the problem is we don't have the infrastructure where we need it. So I would like to comment on T. Boone Pickens. What is he? He's 85 or 88 years old now, and the guy is smart. He's arguably one of the smartest people in the United States. He's had this right for at least 5 years, if not longer, concerning gas, and for some reason he seems to be ignored as old or eccentric or whatever people classify him as, but we need to listen to this man. And like you, I always prefer a free market solution. When the government gets involved, they certainly may say they're there to help, but all it ever results in is hurt.
Yeah, I think what's stopping the Pickens plan from being implemented, in my opinion, is the special interest groups and all the lobbyists. You have the oil lobby, which is very strong, which doesn't want to necessarily switch off the liquid fuels immediately. You have the coal lobby, which has been around even longer than the oil lobby. They don't want the coal lobby still has a lot of power in the United States. And then you have the alternative energy lobby, which continues to get ridiculous amounts of money for corn ethanol and some of these other tremendously uneconomic projects.
Yeah, and ethanol is the stupidest thing I've ever heard of my life. Turning food into fuel has resulted in skewed markets for corn, and
it kills poor people in developing countries who can't afford the increase in the corn price.
Right, and it takes more energy to produce a gallon of ethanol than it generates. So that is, your point's well taken there. Concerning the oil lobby, giant oil companies, they may be lobbying because they very much like the liquid component of petroleum and even NGLs, natural gas liquids. But look what they're doing. Look what Exxon and Shell have been doing over the last year or so, acquiring all these beaten-up gas companies. They have a long term, and let's look at their acquisitions over the last couple of years and look how much money they have have put into taking over gas plays, and they may not.
There's less political risk
right
with the
now,
gas plays.
but they're looking at gas as the future.
Yeah, there's less political risk with the gas plays, too, because a lot of the national oil companies control a lot of the oil assets, and it just seems that any time, they go and make an investment for an oil project in a foreign government, because that's usually where a lot of the remaining oil's left, the government wants excessive terms, but it seems the terms are lower on natural gas plays.
Yeah, I don't really know much about that. I don't follow what goes on in the natural gas market worldwide. I'm more concerned with what's going on in North America, but I do know that gas sells for about I don't know, it's somewhere 350 or so million BTU in the United States, and that same gas sells for $15 in Europe and $17 to Japan and Korea. So what we need to do is find an ability to arbitrage that discrepancy, and that arbitrage can be achieved by liquefied natural gas, and the key to that is going to be tankers that have the ability to pull up to a port, take on gas, liquefy it, and take it anywhere in the world. So we're going to have floating liquefied natural gas plants, compression plants, that will then have the ability to transport that gas where it's needed.
Yeah, I agree, and the free market can hopefully solve that solution without that much government intervention.
We would hope so.
Now, moving on, you always get asked about uranium and some of the other commodities, so let's talk about some commodities that you don't get asked about that often in interviews. We have the food prices for the most part. It seems like corn's going up pretty consistently. Soybeans are pretty much going up consistently due to emerging market demand for more calories and people eating more proteins and things like that, and the world population growing. But why do you think the potash price has been flat then for 2 full years and the potash stocks have gone nowhere? Don't you think then that a higher corn price or those other higher prices would have inspired then the farmers at least maybe taking a break for a year or so to start buying more fertilizers, or is that not the way the agriculture market works?
Well, the potash market is very, very short-term in the fact that it's somewhat a discretionary item. So depending on what farmers think is going to happen in any particular market, will control not only what they plant, but how much potash and phosphorus they will put on there for nutrients for crop yield. So we see a bouncing potash price. It's been down, it's been up, it's been down again. So potash is something that I've never chosen to play in because of the short-term perturbations in the market, and I've certainly considered it. I missed at least one company that I had an opportunity very early on to get in a low price, and I wasn't convinced about the metallurgical process. It's a new process, so I missed that one. But I generally choose not to play in a potash market because it is very speculative and it seems to have rolling ups and downs.
Okay, yeah, and Let's talk about rare earths, because we have a lot of people who still follow the rare earths market, and you were one of the early rare earths, Mickey. The sector has just gotten it's exhibited the classic boom bust where Vancouver and Wall Street way over-marketed many of the juniors that maybe didn't have viable prospects. I was getting emails and text messages from people and comments on our YouTube videos when I did rare earth stuff telling me about companies that were 8 years away from production, that may have had a deposit that I had never heard of, that didn't have any financing, that had drilled one hole, et cetera, et cetera. This was at the height of the bubble. What is your opinion now on the rare earths market? How have things changed in the last 12 to 18 months? How many companies are going to survive in the market going forward?
Well, I think the number that are going to survive are the numbers that we predicted at the beginning of this boom, and that would be about 5 producers at some point. The rare earth market is the equities market, let me say, is controlled by two competing phenomena. And one would be rare earth prices, and those are certainly manipulated out of China. And
Yep.
The other thing, and they have gone down. They went that was the reason for the bubble is the parabolic curve. The bubble and its collapse was the parabolic curve of the prices of the commodities, and this is the way markets work, especially bubble markets. The other thing that directly controls the equity prices of all the juniors in rare space, and there's only a handful that I consider to be viable in the midterm to long term even, and I'm speaking of juniors, but they're all controlled by Molycorp. Molycorp's the 800-pound gorilla on the block. As goes Molycorp, so goes the juniors. Go look at the 4 juniors that should be considered the cream of the crop, at least from the fact that they have arguably the best deposits in the world. And those are the 4 with Amex listings, and I've written and spoken extensively about those, so there's really no use in mentioning him. No reason to mention them here. People need to do their own due diligence on those. But overlay a stock price, a stock chart of Molycorp on those 4 juniors with Amex listings, and you will be amazed to see, as goes Molycorp, so goes its minions. And Molycorp has taken it on the chin. They overpromised. They've underdelivered. They recently fired their CEO for those sorts of things. So if Molycorp prospers, I think some of the other rares that are still trading in the plus $1 to multi-dollar ranges will see better days. If Molycorp continues to struggle, then these juniors will continue to struggle, in my opinion.
Yeah, that's a good point. And because Molycorp and Lynas and Great Western Minerals, which are the 3 near-term producers, none of those companies really have done anything they said they would do at this point. For the most part, they've either had delays, massive capex overruns. They haven't been able to generate the kind of profits that they're seeing in the time that they're seeing it at, the price they're seeing it at. So I think that I think 5 or 6 juniors will survive in the industry. I'd be surprised if there was 8 of them left standing in 2 or 3 years from now. And there's only 2 business models at work, in my opinion. You have the Molycorp vertical integration strategy, and then you have the producers like a Tasman or some of the other ones that you've written about that can produce heavies at a profit. So the ones that have a primary light deposit that are behind Molycorp and Lynas and Great Western Minerals, those guys who don't have heavies are going to struggle.
Well, I would agree with you, but I certainly would not include Great Western Minerals in the same breath as Molycorp and Lynas. I do not think they have a viable deposit that can be developed in any length of time, and the amount of it's a monazite deposit, and the amount of heavies that are going to come out of that deposit are minuscule. The only thing that I think that is of value, potential value with Great Western Minerals, is its less common metals plant in England. But the problem with Great Western is they have a completely blown out share structure, and they are a 10-to-1 rollback waiting to happen, and rollbacks are never positive for current shareholders.
Yeah, I expect a reverse stock split, and it still looks like they're going to have to dilute sometime in the next 12 months because they're having capex overruns, and they've already had some pretty long delays already, too, unfortunately, speaking as a Great Western shareholder. So
obviously, I don't hold Great Western, so and I don't hold Molycorp or Lynas. I missed the boat on Molycorp when it was at $6. Unfortunately, I was traveling at the time. I haven't looked at lately, but I think it's back up to about $11 now.
Yeah, I bought it Molycorp right after IPO, and we got our subscribers to take some gains towards the top, to take some money off the table, and then when it went down to started dropping to 10 and to 6, we started telling a lot of our listeners to continue to add after the big crash, because even if the company gets bought out, I still think the assets are worth quite a lot once the business model is up and running. There's really good cash flows. I just don't know if the management team is going to be able to execute it. There's a lot of execution risk in that stock.
Mm-hmm.
Yeah. So as we wrap up the interview, Mickey here, what is your opinion on the graphite market then? Is it going to turn into what the uranium market was and the rare earths market was? Are they going to over-finance and over-raise so many of these companies, or is there a legitimate need for some of the graphite products too?
Well, there's certainly a legitimate need for North American and Western Europe and even South American graphite producers. I'm convinced we're going to see a few companies do very well in this environment. I am a founding shareholder of one of those and sponsor my website, so anybody interested can go on my website and find out which company that is. I think it's the best one. But that was one of the shortest-lived price bubbles I've ever seen in my life. The price is still high, though. You're still going to get something on the order of perhaps $1,500 to $1,800 a ton for large flake graphite. There are opportunities in this business, once again, for a first in production, and there are a couple of likely candidates, or actually one likely candidate that's going to be in commercial production somewhere, not much in perhaps the first quarter of 2014, if not before, and that just so happens the one I'm a very early on shareholder of. So it reminds me very much of what happened in the rare earth market, the rare earth bubble. It reminds me of what happened in the uranium bubble in 2006 and 2007. These bubbles are what they are. The companies with real deposits and real management and tightly held share structures that are able to get their financing and get in production first are the ones that are going to win.
And you talked about some of the stuff in your checklist there, just a couple of the points that you mentioned. What are some of the other ways and the other things on your checklist for juniors that use to hedge the volatility in the junior stocks? Because we just get so many of the people follow our work. They just talk about the volatility in juniors. They check their account way too much. The price swings are just too much for them. What are some of the things you do to mitigate some of the risk, and what types of things are on your checklist then before you put an investment into a junior?
Well, it all comes down, and I always sound like a broken record about share structure, people, and projects. And being a geologist, I look first at the project. Flagship project, advanced explorers with the ability to have multiple exit strategies. Share structure, I want a tightly held share structure, management with significant skin in the game. If there are institutions, I want that spread around where the company management is not beholden to one large institution. The people, I want them to be technical at the top and have previous experience in the business and have success with that experience. Someone that's bankrupted 3 companies is no longer an entrepreneur or venture capitalist in my book. And then we look for undervalue, and we do peer comparisons. So in a sector, we will do a peer comparison and say, this stock is undervalued. Every one of these juniors will have a double in its 52-week high and low, any running 52-week period. So what we do is try to pick them low, and we sell half when they double, take all their money off the table. Then we're playing with house money. We're playing with other people's money held. Jason, we may even be paying with your money at that point. But then we do program selling both on the uptick and on the downtick, and continuing to take profits and look for other juniors that are undervalued that will double in 12 months or less. We've been very successful since I launched this business model a little bit more than 4 years ago. We picked 16 of 23 stocks have doubled in 12 months or less, and a 17th tripled in 13 months. So if you would be so kind to give me some latitude, we'll consider 17 of 23 to be a success.
I definitely consider that to be a success. And Mickey, when you tell other people, your subscribers that you write, that it's time to take money off the table, just a lot of people aren't going to be willing to listen because they see green and they see all the stuff going up and they see humongous returns in their account and big percentage gains. And when stocks like Stan's Energy went from 30 cents to $3, or Alana Potash went from 30 cents to $2.50, when those stocks have big gains like that, it's time to take money off the table. It's not time to buy more. And that's the difference between someone like you or me, who's more a professional investor and does this and allocates capital like that, than a retail investor who can't control their emotions. And that's why the people are not going to, as a contrarian, most people, it's very difficult for them to be a contrarian because they're not going to buy it low as a discipline. Because when you sit down and tell people, all you have to do is buy low and sell high, everyone nods their head and says, oh, that's easy, I can do that. But they don't understand all the discipline and all the controlling your emotions and all the other things that take place to implement the strategy.
Well, you're exactly right. And we trade. People that follow me, if they follow what I do, it is incumbent on us to trade without emotion. We are not motivated by fear or greed or panic. We do this logically, and we love volatility. We love the extreme volatility of the juniors because that gives us buying and selling opportunities. And for people, retail lay investors included, we try to educate them into how this market works and a methodology, a trading philosophy that works quite well. No doubt works better in bull markets than in bear markets, but this is a buying opportunity right now. And if you want to play in this market, realize that it's gambling, that you should only use your discretionary assets to play in this market.
You're talking about gambling for juniors, right?
Yes.
Not on the producers where there's earnings and things like and
Right,
dividends.
absolutely. I only hold a couple of producers, and when I bought them, generally they weren't producers. They've grown into mining companies. The real money here is made with the advanced explorers, and so it's incumbent upon us to trade without emotion, to welcome volatility, embrace volatility, if you will, and realize that you cannot fall in love with any of these stocks. Stocks are made to be traded, and you do not book a loss or a profit until you sell the stock. There's only one reason to buy a stock, and that's because you think it's going to go up. There are multitudes of reasons for selling a stock, the best of which you've taken your double and you're taking all your money off the table.
Okay, very good, Mickey. I think you wrapped up everything very nicely. So please tell our listeners more about your website and what you do and how they can find your work and some of the value that you would present to them before we let you go.
Sure. I run a free subscriber newsletter. I do something on the order of 2 to 3 interviews a week. My website is mercenarygeologist.com. Run a sponsor model, so companies I cover, I'm a shareholder of, and they pay to sponsor my website. We currently have 6 sponsors. I can be heard 24/7 on streaming audio, mercenarygeologist.fm. This interview will be posted soon. We have a mercenarygeologist.asia in simplified Chinese for people that are either bilingual or prefer to read in Chinese. And I can be reached by over 23,000 Twitter followers now at mercenarygeo.
Great. So thank you very much for joining us on a podcast here today, Mickey, and hopefully we can have you back on soon.
Well, thanks a lot, Jason. It's been a real pleasure.